Hello, everybody, and welcome to Talkonomics. We are coming to you streaming live, living the stream from Brooklyn, New York. And if you are joining us live right now, remember that you can ask your questions during this program on chat, on YouTube. Just put your comments into the chat section, and we will make sure our guests get them. We're also going to take a little bit of a deviation today because I want to tease a few things that are coming up. The first tease is in the first part of the program. Here's a trivia question for you. You get bonus points. We'll give you absolutely nothing for free if you can answer this question. Who is the investor who said, quote, "This time it's different"? We're going to answer that in the next 5 minutes. And then at the end of tonight's live stream, and you got to stick around if you're live, but if you're listening to this on the podcast, you can fast forward. Why are the Democratic Socialists of America cheering President Trump? And I'm not saying that sarcastically. They are absolutely aligned and cheering President Trump. I will answer that at the end of the live stream. But right now, we're all breathing again that sigh of relief because the U.S. economy, the ship has sailed past the iceberg. The S&P 500, positive territory the other day. Let's hope that remains. Although some of us still have a way to go to recover the losses thanks to Liberation Day and the tariff scare, because when you fall, it's bad, but coming back takes longer. Well, it's going to take a little bit longer. But more important, for many of us who are over the age of 40, the last 50 years of investing have been really terrific. And there are some things that have made it terrific. So let's go through a quick timeline as to what has been going on. And this is a financial industry innovation timeline that one of our guests created for us. But let's very quickly, you have 1975 May Day. He's going to explain what that's about. We're not talking about Soviet May Day. The 1980s introduction of electronic trading. The Madoffs were key on that. We'll go there. The rise of internet and online trading in the 1990s. Introduction of exchange-traded funds, ETFs. It goes back to 1993. You have decimalization. Yeah, you used to be able to do the different kind of trading with fractional pricing. That started decimalization in 2000. We had the growth of algorithmic trading in the 2000 and the first growth, what was it, long-term capital, I think it was called. There were some hiccups getting there. In 2010s, we had the proliferation of ETFs and passive investing. We can thank Vanguard for passive investing a little bit before 2010s. And then 2020, zero commission trading and democratization of finance. Now, I am not smart enough to have created this timeline. That's why we're bringing in our next guest. Joseph Rizzello is the chairman of New Square Capital, and he created that timeline for us to help guide this discussion. And Joseph, it is a pleasure to have you here at Talkonomics.
Great to be with you, Adam.
When you and I first started talking about this, I loved that you have the bandwidth to understand where we have been, because that quote, "This time it's different," that was the investor, Sir John, where am I going with this? Sir John Templeton, who said that. And basically saying, look, these cycles, these things are not different. But when you look at the timeline you created for us, what stands out? What's the one thing you would pick from that entire timeline before I break it down that stands out for you?
Yeah, we can spend a lot of time talking about all the things that are different. The one thing that's not different is the stock market. We'll talk about that in a second. But when I came into the industry in the 70s, Adam, just to put it in perspective, we averaged 10 million shares a day. 10 million shares a day. Think about that. You have a stock like NVIDIA that trades an average of 250 million shares a day today. In the 90s, we were in, 500 million shares a day. Just on April the 9th, we traded a staggering 30 billion shares. 10 million shares a day to 30 billion shares. So I would say to you that what's happened over, it's been a great journey for me. Mm-hmm. It's I think, an incredible testament to our industry, because what you mentioned hiccups every now and then. However, every time we have those hiccups, I have found that our industry has gotten better. In the 80s, you had electronic trading introduced. Right. You had NASDAQ come into the game, and back then, the New York Stock Exchange, with all the regional exchanges, the Philadelphia Stock Exchange, the Pacific Stock Exchange, the Boston Stock Exchange. I hate the term regionals because they were part of the national market system, with the New York Stock Exchange. And they did battle with NASDAQ, who was considered
The new fellas.
yeah, the new fellows to the game. But today, I mean, and when you walked into an investment bank back in the 70s and 80s and 90s, there was a separation between the over-the-counter desk or the NASDAQ desk and the listed desk. Today, that's no more. We're all together.
So let's break this down, and we're going to get to what happened in the 80s, and no secret that CNBC, Fox Business, Yahoo Finance, the floor of the New York Stock Exchange, that is a stage. That is all for show. But we don't need to go there because I made my living there and it was good to me. But let's talk 1975 May Day. And we're not talking Soviet, Svimver, Dinover. We're talking May Day for a different reason. What is it that happened on May 1st, 1975 that set up the world we now live in?
Yeah, great question. So May Day 1975, we went from fixed commissions to negotiated commissions, which brought on the onslaught of the discount brokers. Think about it. A 1,000 share trade in IBM round trip was about $1,200. Today, you could do that for nothing. There's no transaction fee on that. But Charles Schwab, Rose and Company, the discount brokers, and that allowed Main Street. It put them on a more equal level playing field with the institutions and the professionals. So that's what May Day 1975 was. It brought on the discount brokers, much more cost-effective trading. A lot of the things that have happened over the last 50 years have wrung out billions of dollars in cost. Today, the barriers have come down completely. The individual investors are on the same level playing field as the institution.
So you brought up NASDAQ and you brought up the introduction of electronic trading in the 1980s. And having covered the Madoff scandal, I interviewed Madoff in prison. His brother Peter Madoff was instrumental in helping write code that created NASDAQ. What are we talking about? Is that what you're referring to? That starts in the 1980s?
The Madoffs were big on NASDAQ. I actually know both Peter and I knew Bernie as well. It was a small industry back then. Everybody got to know each other. And if you worked for an exchange like I did, you got to know those folks pretty well. But they were third market traders, okay? They used to make markets upstairs. They used to make markets on NASDAQ. But no, I think that electronic trading, the advent of technology, even the trading floors had to adopt technology. Think about it. Back in the 70s, 80s, if you had on a trading floor, you used a telephone, you wrote a ticket, you gave it to a runner, they brought it into the crowd, and people were waving their hands and yelling and screaming.
Trading places, the famous scene when they're selling, the orange juice futures. Get in there and sell.
And then, of course, later on in the late 90s, early 2000s, it brought the algorithmic traders who really changed the game, and that's the reason why you can handle the kinds of volumes. Back in 2008, okay, you're trading maybe 5 billion shares a day, and that 5 billion shares a day would shake the systems. As I said, on April the 9th, we traded 30 billion shares a day without a blink. There was no problems at all. The markets were humming because of technology. Technology allows things to move a lot faster, more effectively, more efficiently, and it wrings out all the cost in the business. So
okay, so let's talk. What made that possible, though, was the 1990s with the internet and online trading. And I'm talking about the You've Got Mail. That guy lives in Akron. I used to live in Cleveland. I years ago got to meet him when he came to our TV station. But how did that seem to be the foundation that has created the ability today to trade 30 billion shares in one day?
Yeah. So many of the exchange, NASDAQ, the form of electronic trading, you didn't have to be in a physical place, or yet you could sit at your desk, you could be in a building, and you have access through telecommunications to the markets. Many of the exchanges that adopted that technology, they allowed their member firms to reach their trading floor through telecommunications as well. And then, of course, when the internet came into effect, now investors can go online on their computers and bring up a trading platform and get direct access to the trading floors as well. But just think about 1987, October 19th, 1987. because we were talking about the significant volatility that we've experienced just about 5 weeks ago. In 1987, an executive at the Philadelphia Stock Exchange. The market was down 20.5% in one day.
Right.
And that was the first billion share trading day. And by the way, we didn't reach a billion shares after that for several years. But a billion shares traded that day, and it was incredibly challenging. And some exchanges wind up shutting down because there was not straight through processing. Paper got stuck in the pipes, and they had to basically shut their exchange down to empty the pipe so they can process the orders.
So let's finish out the 1990s with ETFs. Because this is the point where I'm coming into the scene, and I've been a passive investor with I would be cursed for this today, but it was mutual funds. I didn't have access to ETFs until the 90s, and even then I didn't understand them. How has that leveled the playing field? And would you make any changes to the way this has all happened?
Well, in terms of mutual funds and ETFs?
Well, the introduction of ETFs.
Yeah, so exchange traded funds were introduced back in 1992 by the American Stock Exchange. Actually, I was an executive at the Philadelphia Stock Exchange. We had the forerunner to the product. It's a famous Third Circuit Court case. We brought the cash index participation, which was the forerunner to the ETF. And what happened then is the commodities exchange or the futures exchanges sued the SEC for approving our product. And the case was heard in the Third Circuit in Chicago. And Judge Easterbrook, it's the Easterbrook decision, said that while this cash index participation, by the way, we listed a cash index participation on the S&P 500, and we listed a cash index participation on the Dow Jones. So again, the first foray into the ETF business. And he decided that while this had every 99% element of securitization, it did have an element of futurity, and he struck the case down. And then, of course, everybody went to the drawing board. The first exchange, though, to bring an ETF, as we know it today, was the Toronto Stock Exchange, not the American Stock Exchange. They listed an ETF on the Toronto index, and then, of course, spiders came. And they floundered for a while. It came in 92, and ETFs were not really popular in the beginning.
Let me interrupt real quick. When did the liquidity that an ETF provides, so that you don't have to wait till the end of the day for your mutual fund to settle and then to sell and do whatever you're going to do? When did people start to appreciate that factor with an ETF?
Yeah, probably late 1990s, early 2000s, when actually the investment banks got into the business of issuing these ETFs, and the market makers started to place, and you created the creation redemption process. But let's talk about ETFs today, right? Okay. ETFs now far surpass, in terms of net assets far surpass mutual funds. Mm-hmm. In 2024, globally, $15 trillion in ETFs. 10 trillion of that 15 is in the United States. While mutual funds 3 years in a row, have bled cash, we had net assets out. In 2023, $512 billion net assets out of mutual funds. In 24, $388 billion left mutual funds. And in 2025, another 21 billion have left. So that's important too, because when ETFs first came to the market, all the mutual funds in the country were against it, right?
Yeah, now, I wonder why.
Well, but now, I remember, true story, 1996, I met with the chief investment officer of Vanguard. I eventually went to Vanguard. I went to work for Vanguard, and they said that we would never bring an ETF. When I went to work for them in 1998, Gus Sauter called me into his office and said, we're getting into the ETF business. Yeah. So now you have just about every mutual fund company in the business involved in the ETF business are big issuers of ETFs.
So when you take a step back, And I'm going to bring our next guest in about 5 minutes. But when you take a step back and you look at all of this, this has been to the great benefit of people who I'm not in the financial world. I was a TV reporter at a 401k, and all of this helped people like me save up for savings as our pensions were decimated and put to pasture in ways that had these things not taken place, we wouldn't be able to have a future. Do you think we could have this kind of revolution in finance going forward, or are we kind of at peak efficiency?
Yeah, no, I don't think we're at the peak. Listen, AI, what's that going to do? Nobody really knows, right? What artificial intelligence is going to do, and we already know that it's creating some amazing things in terms of how it processes data. What about crypto? You got cryptocurrencies. They're not going away either. No, I don't think that the innovation has peaked at all. It continues to come. You have all these fintech firms. Technology is the X factor, right? With technology, it allows you to do so many things so much more quickly. The way we process business today is far superior than it was even 10 years ago. As I said, we couldn't have had a 30 billion share trading day 10, 15 years ago. Now we're handling, the exchanges are handling it with ease.
I'm going to ask a Luddite question about algorithmic trading. If the algorithms were so wonderful and perfect, and we had the hiccup, it was 97 long-term capital management. But if it was so perfect, why wouldn't everybody just do it and make trillions of dollars and go to bed?
Well, the algo folks were young men and women coming out of business school with an engineering degree and a math degree. Old habits die hard. The market makers, let's take a firm like LeBranch, who was a big publicly traded specialist on the floor of the New York Stock Exchange, had a multi-billion-dollar market cap. They were publicly traded. That went to zero. Okay, a lot of those market makers and specialists basically fought the algo guys. That was a whole new breed, and nothing's perfect. I wouldn't say algos are perfect, but they make the market far more efficient because we think about it. It wasn't too long ago that 30 seconds was the time of a trade process. All the exchanges would communicate through the intermarket trading system, and they would have 30 seconds to respond. Today, you're trading in microseconds.
Yeah.
That's
Michael Lewis's book, laying the fiber cable from New York to Chicago.
Yeah, no, I think algos initially got a bad name, but I think that the U.S. stock market arguably is the most efficient market in the world, and the algos are the next generation of market makers and specialists, and they use computers, to basically run those algos, which makes the markets, from a pricing point of view, far more efficient today than they ever were.
And I'm being selfish because I'm getting this discussion just you and me. Last, just me question to you before I bring our next guest in. When you say the democratization of finance, how would you explain that to people who don't know this very rich and robust history that you have lived? How would you explain that?
I would say that you level the playing field. I mean, think about it. I came into the business when 10 million shares was a busy day, and you had to close on Wednesday because you needed to handle the paperwork. So Main Street was not there except through their pension fund, perhaps. So when you had the discount brokers come and lower costs, the barrier came down quite a bit at that point and allowed Main Street to come into the business. When you brought in online trading, technology again, online trading, individuals now can go onto their computer and get access to the markets. And today they have access to exchange traded funds, which are arguably the most innovative financial product that has been brought to the market in the postmodern era. So when I say that same thing with spreads. When I came into the business in the 70s, the spread was 1/4 point, 25 cents. Then we went to 1/8, a 16th, and it stayed at 6 1/4 cents. Now we're at pennies and fractions of pennies. Okay, all of that is accrued to the benefit of Main Street and investors.
So, when we talk about the democratization of finance, our next guest, Joseph, you represent the generation that created and delivered this. Our next guest is a self made CMT. He's a chartered market technician who has founded his own company. He has Dante's Outlook if you want to check out his website. But Dominic Dantes is joining us now. And I'm sure you've been listening, and thank you for being patient. And I purposefully set it up this way because this time is different. For you, Dominic, you got into the world that Joseph just described that was created over the last 50 years. What is it that drew you into finance?
Yeah, I mean, my parents had me at a very young age, 19, and my dad went to Baruch where he studied business. And I think for me, I always had an interest in business and learning how a company is formed. And then I realized that there were listed shares, and I was always glued to my TV to understand what was going on at CNBC, right? So I think that was my early interest in the market, and just knowing that I can plug in the modem back in those days and access Yahoo Finance and kind of see tickers and kind of participate in that world was very exciting for me as a child. And then I was able to translate that knowledge and passion to my peers, right? So I had a stock market club in school. And I think also going through many cycles in my early age of learning about the 90s boom and bust, the Enron and WorldCom scandals, 9/11, and also just seeing not only the fear, but the resiliency of our economy and our capital markets at work empowered me to really study it at college. And I think that was my sort of beginning.
So help me understand how, as a chartered market technician, you are part of the continuing evolution and revolution of finance. How are you taking part in that process?
Yeah, I think a big thing that we do on the CMT Association, I'm a board member there, is outreach, right? So we partner with a lot of academic institutions to help them realize that this can be a part of the curriculum, allowing students to learn about the market cycles, but also allowing them a particular edge in creating their own investment process. Also understanding that there is a time and a place for trading versus investing. Those are very basic skills, but it's also very relatable. So we do a lot of that within the CMT group.
In fact, you provided us with a full screen, which I believe we can bring up, which talks about these cycles. And again, we were going through some of the cycles with Joseph, but walk me through what you created for us with this image: the early cycle, the mid cycle, late cycle, and recession.
Yeah, so a lot of people, utilize the business cycle to think about investment positioning. So I use this same concept that we use at Fidelity to understand business cycles and different asset classes work during different times. And as you know, the early cycle environment is when we're coming out of a recession, then when there was peak fear, but there's a lot of opportunity to realize the first initial market gain. And then you head into mid cycle where the economy is kind of working at potential, but there's some excess that's getting in there. Things are kind of choppy. And then you enter in the late cycle phase when the economy has kind of worked off its excess. You get the inflation as a result of above trend economic growth. And that's where a lot of inflation protection and low volatility assets become more favorable. And obviously, everyone's scary point, the recession that
Hmm.
occurs, it's typically the shortest part of the business cycle and where most of the opportunities are realized. However, recessions come in different flavors, right? You can have a financial crisis like what we saw in '08, or you can have a minute sort of profit recession where it's just a valuation reset. So we tend to think of these phases in terms of right sizing your investment playbook.
So before I bring Joseph back into the discussion, one last question directly to you, and then I'll let him follow up. Where are we, do you think, in the cycle? Because this time is different. I mean, it's just crazy. Dominic?
Oh, for me? So I tend to see it in terms of like the economic cycle versus the market cycle, right? So I rely on a lot of leading economic indicators and surprises, right? So you have inflation surprise and an economic surprise. So I would say looking at leading economic indicators, we're actually at a trough since 2022 when a lot of the recessionary environments were being priced in. And we're kind of exiting out of that scenario. So that's where I see the leading economy in. The coincident economy, which is as a result of, right? So inflation kind of heading down, you're kind of late cycle environment. Now, the market has actually been pricing in again a recessionary environment where again a lot of opportunities are being realized, valuations have now come back down to a normalized state. So that's kind of where I see it. The market and now kind of coinciding with the economy where it's an actually a larger opportunity set.
Joseph, what do you think? Is it
Yeah,
how do you?
so yeah, when the recession, I mean, I guess we had a 2 month recession in 2020.
Yeah.
They've been talking about recession the last 3 years. We haven't seen the recession yet. Maybe this time. What do you think, Dominic? Are we actually going to? The economists predicting recession now for the last 3 years, which hasn't occurred. Now we did have
Mhm.
1 quarter negative growth. Do you expect that we're gonna see a second quarter of negative growth? Doesn't look like it to me from this point.
Yeah, it doesn't really seem like it. I think we had like a semi-technical recession in 2022. Um, give and take, we might, right? Profits have been pretty exuberant. There was a lot of froth heading into this market. So, even if we do, it'll be realized, but very short term, right? I don't think we'll enter in a crisis of sorts. It's actually very nice if we have a nice recession because that lowers inflation back down to normal standards. As long as there's not widespread pain, it's a nice reset. And again, the conference board, once they come out with their recessionary sort of place mark, it'll be well after the fact. They wait for a lot of confirmation. So the market will actually be moving well ahead of that. And that's where you got to participate.
Dominic, what is it that, why can't we take all of this data? We have 50 years plus of data that we could
Mhm.
load into ChatGPT, pick your, 4.0 or even 5 is about to come out, or into Gemini. We could load in the economic cycles and history that we know. Why can't we just load that in and say to the AI, okay, what should I do in order to get this return? Or can we do that, and is that happening?
Yeah, that is scary, right? So you wouldn't want to trust that because it's incorporating all the historical data, but not the real-time data, right? And not the expectations that might come about. And of course, investing is highly personal, right? So it's based on whatever positioning or expected return you have, and you're adapting that to the current environment. That's not something that you can be able to program, expert or sort of accurately, right? So you always have to take into consideration the current environment and the different placements that are at work. And that's why we take a more sort of measured approach, right? Something more binary, where we're actually incorporating real-time market data to understand, okay, well, we don't have to forecast where the economy is heading. All we need to do is identify where the trend is and also calculate momentum on top of that and sort of position accordingly. I think that what you'll realize is it tends to rhyme with a particular cycle very well instead of having to sort of guess where things are headed.
Joseph, what do you
So,
think?
yeah, Dominic mentioned inflation. So inflation, recession, it goes back and forth. The Fed's getting pretty close to their 2% target. We're likely to have the first cut in a while in June. So my feeling is that Dominic, I'm not sure what you're thinking is right now. Is it more inflation or is it going to be a recession? Where do you think we
Mm.
are in the cycle?
A little bit of stagflation, right? So I think
Right.
that has been the norm now, right? People have kind of gotten accustomed to that, where you have slower economic growth than normal and a sort of peak or elevated inflation levels, right? It's coming down, but it's coming down at a slower pace than what the Fed would be more comfortable with. That's stagflation. What that does is it actually complicates the correlations between bonds and equities, right? Because bonds, not so good of a buffer, equities, a little bit more volatile. So where do you go, right? It's hard to diversify in a stagflationary environment. You're either going to need one or the other: high inflation, low inflation, high growth, low growth, but both at the same time, not so fun for an investor.
Do you think we'll get the rate cut in June? I personally feel that the Fed was late on the way up, and they're
Mm.
probably going to be late on the way down. So, do you think
Hmm.
we're going to get a cut in June?
Perhaps, yeah. I mean, the 2-year yield has now, ventured below the Fed funds rate. That's typically a precursor for a rate cut regime. So I do think we're going to get that. It's just not going at the same pace as what the market would expect, given all of these factors like tariff uncertainties and elevated inflation still, and economic growth is still positive, right? So I think all of those factors come into play, but a lower rate cut regime is definitely going forward.
So
So Adam,
Joseph,
I have a quick comment
yeah.
on the market itself, though. We talked about 50 years of incredible innovation, and the changes that have taken place in financial services, particularly as it relates to the markets. The one thing that hasn't changed is the market itself, right? The market's driven by the irrefutable law of supply and demand. At the end of the day, it's that simple, right? More buyers than sellers, stock prices will rise. More sellers than buyers, they'll go down. Equal buyers and sellers will stay the same. That hasn't changed. The fear and greed and the emotions of the market basically is the same as it was 50 years ago.
So Joseph, let me ask you
Mhm.
this, and then I'm Dominic, pick up after Joseph. Uh, we're going to hear from Jay Powell tomorrow. He's going to speak on Thursday, May 15th at
Yes.
8:40, and the Fed likes to signal to the markets what might be coming down the pike. And when I listen to the pontificators on CNBC and the other Fox Business and the other networks, they seem to think that the Fed is pushing the rate cut out past, June. They're talking end of the year. What do you think we're going to hear from Powell tomorrow? And do you think he would signal if they were going to go as soon as June?
Now, I think he's pretty careful in the way he uses his words. My feeling is we're not going to have a definitive sign as to what he's going to do anytime soon. I don't think he's going to signal that there won't be a cut or there will be a cut. I just think that he's going to be careful. I think his mantra is, they're steeped in the data. They're going to continue to watch the data.
Dominic?
Yeah, for me, I mean, I don't know. That's a simple answer. I can't read the Fed tea leaves. I don't know. I'm not in that room. But what we can rely on best is we know that the Fed does not make preemptive moves. They tend to lag, right? So similar to COVID, inflation was transient until it was realized, and then you see the Fed rate hikes, right? Now it's kind of like the tariff uncertainty is there until we realize the actual effect of it, and then you see the Fed act. So I think a lot more of the uncertainty just has to be kind of put away. The tariff environment is still kind of up in the air. Economic growth and inflation, those numbers are coming out, but they're not, we don't have a solidified view of where we are in the cycle. So yeah, I mean, we'll see what happens in June, but I think after the effect, then we'll see more of the data be realized.
Dominic, what happens to investors in the United States if the position of the United States as the place to park your money, whether it's in fixed income or in capital and equities, what happens if that has been changed by the policies of the current administration?
I don't think it'll change too much. I think that what happens is, there is a huge valuation discount between the US and the rest of the world. That's pretty attractive to allocate some capital to an opportunistic bucket that would take advantage of the international markets. The US is still very much outperforming over the long term. We have a robust capital market, and that should be the core of your domestic portfolio for sure. You create these little tactical buckets outside of that. I think that's just kind of what's going to happen.
Joseph, what do you think?
My feeling is that I don't want to see interest rates go to where they were, 3 years ago, 4 years ago. I don't think that kind of easy money is what got us into a lot of trouble. I do believe a little bit, maybe a quarter to a half a point cut in total between now and the end of the year could be healthy. Dominic mentioned the economy is slowing. I think a quarter of a point cut in June would help a little bit. Whether we get it or not, I agree with Dominic. No one really knows at this point.
Mhm.
And
I
Dominic,
would
do you
agree
have
on the interest rate front. We look at long-term trend shift on the 10-year yield. 3.5 is typically the breakout new base, right? So again, you're coming off of an environment where you had a nice living yield of about like 7 to 8%, and now it's kind of low, but higher than the low rate environment that we saw. And obviously, keeping rates low for too long creates a lot of froth and exuberance, right? So you don't want that. A higher than normal, right, rate is actually pretty good for the market. It forces you to focus more on fundamentals, and it kind of keeps the market in balance. So I do expect rates to remain in a higher than normal range of about 3 to 5%. And we'll see where that goes.
And they're historically normal, right?
Yeah, exactly.
I don't know what
Yeah.
historically normal would truly mean. But let me, Dominic, do you have a question you want for Joseph before I continue to monopolize the questions?
Yeah, I think, Joseph, thinking about previous cycles, like where have you kind of seen, sort of frothy environments and fear kind of play out over time? Like, has it kind of reset the market to a much more stable mechanism, or is it kind of continued?
Yeah, I mean, I think that if it wasn't that, I think this market obviously is very news sensitive, and I think a lot of the news media were fanning um, the the fears out there in early April. My feeling is that if it wasn't tariffs, it was going to probably be something else. To your point, and the market got a little bit frothy. But I mean, we're the indices right now are all back at slightly down to even for the year, or at least the major indices. So um, I don't know. I think that my feeling is that the market really we should be looking for opportunities here.
Do you
Hmm.
In my
do either of you is there value in the VIX and the volatility index? Should we be paying attention to it, or is it one of those things that CNBC, Fox Business, Yahoo Finance used to keep us watching and scare the you know what out of us?
yeah,
I'd
well, I
still use
mean,
it. Yeah.
yeah,
Joseph?
I would agree with Dominic. The other thing is that when we were going through this massive volatility in early April, and investors' sentiment was the lowest ever recorded, even lower than 2008, which is pretty amazing, right? And look where we are now.
Hmm.
So, Joseph,
Agreed. Yeah.
let me ask Joseph this question, and then Dominic, you can jump in because you have that kind of global visionary look of this. I keep hearing stories about outflows. We talked about outflows from mutual funds.
Hmm.
I'm talking about outflows from in equities in the United States to Europe and to other parts of the globe, where for the last 10 years it's been coming this way. Now I realize that it's supposed to do that, but why should I not, as an investor who is very heavily based in the U.S., be not afraid of that?
But not afraid of outflows. Money moving internationally. Yeah, the international markets have had a better year than the U.S. market. But my feeling is that we always weather these storms and get through them. And I look at a long term chart from 1970, right? I mean, and we've had some major, like in 1974, the market was cut in half. I was in the business at that time. I'm not sure how I survived that downturn. But if you took a $10,000 investment in 1970, what do you think it would be worth at the end of 2024?
Two
Any
million dollars.
guess?
I'd say $2 million.
You're right. It's like $2.3 million, right? So we do weather these storms. I mean, it's I don't think, I don't think the news of tariff is going to turn a good company into a bad company, in my view. So if you believe in America, my feeling is that you'll continue to think about where you want to put your money for the long term.
Dominic?
I agree. I think, it's funny at Global X ETFs where I used to work, we had this term of, international markets, you rent, you don't own. They have these tactical areas of outperformance and underperformance, but over the long term, US markets do continue to dominate, right? That relative ratio is still in a very sharp uptrend. So you don't want to cannibalize your portfolio with all these other different things, right? The important thing is to know, right? Your US allocation at the very least should be balanced with some global diversification, right? But do it at an appropriate size. I think that's the expertise of portfolio management. It's like a risk budgeting approach, right? So that's kind of what we've been doing. We've, equalized our exposure to US equities. We've, reduced the long-standing overweight, added some emerging markets and European, but at the same time, we're not getting rid of our US and putting it as extreme underweight. That would be foolish, right? Because we are looking for long-term gains with some opportunistic allocations here and there. So I think that's what investors should do. It's a wake-up call to not just have a US dominated portfolio, add some diversification on top of that, and just remain opportunistic when the opportunities arise. And also know that flows are backward looking. They tend to be a contrarian indicator. After the money has moved, they take profit when it becomes overvalued or too stretched. Investors should, move accordingly.
Final comment from either of you. Let's start with Joseph. Is there anything you want to leave the audience with?
No, I would just say that, again, I'll just repeat what I said earlier, and that is that the market is the same as it was when I first came into the business. It doesn't change. It's really, again, it's based on the irrefutable law of supply and demand, and there's ways you can track supply and demand, and you use that with risk management. And I think that I tell people out there, when you go through these periods of volatility, be calm and keep a cool head, and the longer you go out, the greater the smoother the ride, and the better chance of a good return.
Dominic, final thought from you?
Yeah, agreed. I think the topic of this show is important, right? The evolution of markets. I was a benefactor of that. I think also, technology lowers costs, is increased accessibility, but it also requires the onus is on these providers and fund managers to be disciplined and do what's right for the end investor. Discipline is key. Knowledge is also empowering.
And very quickly, where can people find Dante's Outlook? How do they get more from you?
Yeah, thank you. Dante'sOutlook.com is our website. And then on LinkedIn, if you just search Dante's Outlook, we have a page there where we actively put together research and share it.
And Joseph, I would imagine if people want to get hold of you, they would go to New Square Capital, correct?
Correct. NewSquareCapital.com. Thank you.
It's good to be the CEO, isn't it? I appreciate both of you being here. Now, we're not done yet because I had promised everybody at the beginning of the live stream I was going to explain why the Democratic Socialists of America are cheering Donald Trump. But at this point, I want to say thank you to Joseph Rizzello and to Dominic Dantes, both of you. It was great to have you here at Talkonomics, and I hope both of you will consider coming back in the future.
Absolutely. Thank you, Adam. Take care, Joseph.
So now I'm going to answer that question. And, the reason I'm bringing this up is here in New York City, we're about to elect a Democratic socialist mayor. Now, the primary is in June, but there's a Yiddish word, fakakta, and it means what it sounds like. We do ranked choice voting, and there's a real potential for a young man who is a Democratic socialist to win the primary. He's running against Andrew Cuomo, and he has huge popular momentum. His name is Zoran Mamdani. We've reached out to him twice to see if he would come on to talk. He is incredibly popular, and I've gone out on a limb and I've told my friends I think he's going to be our next mayor. I'm not making a judgment call whether he's good or bad. What I'm saying is you should listen to what people are telling you because they will do what they say. And in this case, Mr. Mamdani and the Democratic Socialists are promising all kinds of things. One of the things he's running on actually sounds like a great idea. Free MTA, the Metropolitan Transit Authority, free bus rides. Now, look, we could get into the whole numbers game about what that would cost. But honestly, bus fares raise about $500 million. I did the numbers. As long as you can figure out how to pay for it, then okay, go for it. We can have a discussion whether it's the right thing to do. But here's the other thing you should pay attention to. And you should ask people like Mr. Mamdani, as well as Alexandria Ocasio-Cortez and Bernie Sanders, what do you think? Because when they tell you what they're going to do, you should listen. And right now, there is a movement. Young people are very much behind people like AOC and Mr. Mamdani because they bring a fresh air, a fresh voice to a discussion that has been controlled by people who should move and get out of the way because they're past Medicare age. You know who I'm talking about. Those people need to pass the leadership baton on to others. But if you pass it on to AOC, what are you really doing? Because she is a Democratic Socialist. So I went into the Democratic Socialist preamble from 2021. It is still relevant today. And here are some of the things that they're talking about doing. And this is a direct quote. Social ownership and democratic control of utilities, key industries including railroads, water, gas, electric, telecommunications, media, and internet service providers and other critical sectors of the economy through direct government support, public banks, and pension funds at every level of government. Now think about that. You've seen the crowds that AOC and Bernie Sanders are getting. Is this what you want? Do you want the government to control all of these things. You might be able to make a good argument for why the utilities should be government controlled. But media? Do you want the government to control Fox News? I think some people would like that. Do you want the government to control MSNBC? I think some people would like that. But that's not what we're about in the United States. And here are a couple of other things from the Democratic Socialists of America preamble. They want to disarm law enforcement officers, including the police and private security. They want to abolish all asset forfeiture programs and laws. Now that actually makes sense. That gets abused. But do you want your police officers disarmed? They also want to, quote, end all misdemeanor offenses, accounting for 80% of total court dockets, reduce jail churn by reducing arrests, and cut funding to prosecutors' offices. Look, come to New York City. Everything is behind a lock and key. You walk into a CVS, it's behind a lock and key. Is this what you want? I'm not saying it's the right thing or wrong thing. I personally don't want it. But this is what you're voting for if you vote for these people. This is the platform. And then I'm going to answer the question. Why are the Democratic Socialists cheering Donald Trump? Because they say this in the preamble. Rewrite the rules of trade embodied in bilateral and multilateral trade and investment agreements like NAFTA. They're cheering that because that's what Donald Trump is attempting to do. But they say together to strengthen rather than erode environmental protections, but also to strengthen the power of labor and the ability of global South nations to chart their own development paths. They also want to do something, they call for this in their preamble, something that Donald Trump has already done: abolish USAID and the Voice of America, as well as other governmental agencies that cynically disguise capitalist control as aid and journalism. Look, let me wrap this up real simple. Believe the Democratic Socialists when they tell you what they want to do. And I shared this with one of my closest friends. I have known her for years. She is a good soul, and she's a wealthy woman, but she walks the walk, and she is a socialist. And she said when I pointed this out that this was right-wing banter to scare people. It's not right-wing banter. It's coming right out of the Democratic Socialist platform. And in 2016, I was able to interview Maria Svart, who was the head of the Democratic Socialists of America. I did this at Fox. And she said in that podcast, still online, you can hear it, that they don't believe in private property. You should not own your house, your apartment. Your neighbors should be able to determine who gets to live where and how. She said that. That's when you see these crowds for AOC and Bernie Sanders, they very well could be elected because there is a huge amount of momentum and need for some of the causes they're raising. We need to protect Social Security. They are dead on right when they talk about that. But this is the platform they're running on. And I just want to read that quote to you one more time. Social ownership and democratic control of utilities and key industries, including, they go through the whole thing, railroads, water, gas, electric, telecommunications, media, and internet service providers, and other critical sectors of the economy through direct government support, public banks, pension funds, and every level of government. When you see those crowds, is that what you want? We'll see you next week.